Welcome to today's deep dive. We've actually got a pretty intense mission on the docket for you today.
Yeah, intense is definitely the word for it.
Right. Because we are decoding this really high stakes, highly stressful world of pre-foreclosure. Basically looking at the underlying mechanics of what happens when a property owner is just, pushed right to the financial brink.
And crucially, we're uncovering the strategic safety nets that are actually available to you before a bank steps in and takes a home, because they're a safety net.
Exactly. And to guide this exploration, we're pulling from a pretty comprehensive advisory guide. It was published in April 2026 by a family-run real estate investment firm. They're called Sarasota Sell House Fast Buyers.
Right, and I want to point out right away, while this source specifically evaluates the local dynamics of the Sarasota, Florida real estate market, the core principles we are going to dissect today, they're universal.
Yeah, they apply pretty much everywhere.
Exactly. We are talking about the architecture of mortgage debt, the aggressive preservation of your home equity, and really just crisis management in the modern financial system. This is financial literacy everyone needs.
Okay, let's unpack this. Because we have all this rich data on financial strategy, but to really understand the value of these tactics, I think we have to start at the catalyst.
The catalyst, right. The moment it all becomes real.
Right. Because, checking the mail is usually a pretty mundane experience for you. You expect utility bills, a few catalogs, maybe a wedding invitation if you're lucky.
Just entirely routine stuff.
It's totally routine.
Yeah.
But imagine walking out to your mailbox, flipping through that stack, and seeing a certified letter from your mortgage servicer. And it's not an annual escrow update.
No, it's a formal notice of default.
Exactly. The expectation of safety you have in your own home just vanishes in an instant, and suddenly you are on a very real, very terrifying ticking clock.
It really is. That certified letter represents a profound psychological shift. It's the moment the abstract anxiety of financial trouble crystallizes into a stark legal reality.
It's no longer just a worry in the back of your mind.
Right. The machinery of the banking system has officially been activated against the homeowner, and that machinery is intimidating.
It is. And when people hear the word foreclosure, I think they tend to envision, like, a Hollywood montage.
Oh, for sure, the dramatic movie version.
Yeah, like a stern banker in a suit shows up with a sheriff. They slap a heavy padlock on the front door, and the family is just out on the curb that very afternoon.
Right, the immediate eviction.
But the mechanics of the process are far more bureaucratic, aren't they? Let's look at the actual timeline the source lays out. How much time is genuinely on that clock for you from the moment you miss a payment?
Well, the timeline is actually where a lot of the initial panic stems from, largely due to, a lack of understanding regarding banking regulations. A single missed mortgage payment does not trigger immediate legal action.
It doesn't. So you have a bit of a buffer.
You do. Lenders operate under regulatory frameworks that typically require an account to be a full 90 days past due before they issue that formal notice of default.
Okay, 90 days.
Yeah, 3 months. During those first 3 months, you are basically dealing with collections departments, phone calls, late fees, warning letters.
So the borrower has a 90-day runway before the alarm bells reach a critical public-facing pitch.
They do. However, once that notice of default is actually filed, it crosses a major threshold because it becomes a matter of public record.
Oh, wow. So anyone can see it.
Exactly. Your financial distress is now visible to credit bureaus, to real estate investors, and the broader legal system. Now, the guide highlights a critical structural detail here. Florida operates as a judicial state for foreclosures.
Which fundamentally changes the dynamic of how a bank can repossess an asset, right?
Completely. In a non-judicial state, a lender can often foreclose pretty swiftly outside of the court system. They just base it on the power of sale clause in the deed of trust.
But Florida is different.
Very different. In a judicial state like Florida, the bank cannot unilaterally seize the property. They are legally required to file a formal lawsuit in civil court.
Wait, a full lawsuit?
A full civil lawsuit. They must serve the homeowner with a summons, they have to present their evidence of the debt to a judge, and they have to obtain a court-ordered judgment before they can even schedule a public auction.
If we think about this in terms of, game theory, Florida's judicial requirement acts almost like a mandatory sports timeout.
Oh, I like that analogy.
Yeah, like when a homeowner is backed up against their own end zone, the bank can't just run up the score instantly. This mandatory legal red tape is actually a lifeline for you.
It really is.
It forces a pause in the action, giving the property owner a critical window to draw up a defensive play rather than facing an immediate, game over scenario.
What's fascinating here is that timeout is arguably the most valuable asset the homeowner possesses in this entire scenario.
Because time is the one thing you usually don't have.
Right. The clock is ticking, yes, but the property remains entirely in the homeowner's legal possession throughout this entire judicial window.
The bank doesn't own it yet.
Exactly. The bank only holds a lien, right? They do not hold the title. This means the agency to resolve the situation, to sell or restructure the asset, it still rests firmly with the owner.
Assuming they act quickly enough.
Right, if they act swiftly. Now, the guide points out that how aggressively a bank pursues this lawsuit often depends on local variables. They analyze factors like current Sarasota property values, neighborhood demand metrics, and prevailing interest rates.
Because the bank is constantly assessing their own risk exposure. I mean, if a distressed home is sitting in a highly desirable coastal neighborhood with rapidly appreciating values,
The bank wants that money back.
yeah, the bank knows they have a very clear, very profitable path to recouping their capital through a foreclosure auction.
That is the exact mathematical calculation happening in the lender's back office every single day. Understanding the current retail market value of your asset compared to your outstanding debt is basically the foundational step in formulating any defense strategy.
Which leads us directly into the playbook. So the homeowner is in this judicial window, the lawsuit is filed, but they still hold the deed. We are transitioning from the anatomy of the problem into the data-driven solutions provided in the source.
Right. What can you actually do?
The guide evaluates 4 specific escape routes. Let's look at them as sort of a narrative of escalation, right? Starting with the homeowner trying to keep the property and ending with taking drastic action to minimize the fallout.
The comparison table in the guide grades these 4 strategies based on 3 vital metrics: the timeline to execution, the required effort from the homeowner, and the long-term impact on their credit profile.
Okay, so the first logical attempt is the loan modification. You want to stay in the home, so you petition the bank to alter the original terms of the mortgage.
Makes sense on paper.
Right. But according to the data, this process takes anywhere from 3 to 6 months. It has a moderate to high impact on your credit, and it requires an intensely high level of effort.
Yeah, a loan modification is essentially a grueling forensic audit of your entire financial life.
It sounds awful, honestly.
It is. You are asking the lender to take your missed payments, any accrued late fees, and roll them back into the principal balance of the loan.
So they basically restructure the debt.
Right. To make the new monthly payment affordable, the bank might lower the interest rate or stretch the amortization schedule out to, 40 years. But to get approved, you must prove a sustained financial hardship while simultaneously proving you now have enough stable income to meet the modified payment.
That's quite the needle to thread.
It involves endless paperwork, trial payment plans, and just constant negotiation with loss mitigation departments.
It is a bureaucratic marathon.
Yeah.
And when that fails, or if the homeowner simply cannot afford the home anymore, we escalate to the second option, which is the short sale.
The dreaded short sale.
Yeah, and the metrics here are daunting. A short sale takes 4 to 9 months to complete. It requires massive effort to secure the bank's approval, and it inflicts a severe, heavy impact on your credit score.
Severe is putting it lightly.
Here's where it gets really interesting, though. Let's pause on the mechanics of a short sale, because this is where the logic gets really murky to me.
How so?
Well, if a short sale takes up to 9 agonizing months to push through the banking system, and it still absolutely wrecks your credit profile, why on earth would any homeowners subject themselves to that process?
It's a fair question.
Isn't a short sale just a slower, more painful way to lose your house? And for that matter, why would a bank agree to accept less money than they are owed?
If we connect this to the bigger picture, you have to look at the internal balance sheet of a major bank. Banks are in the business of lending money. They deeply, deeply loathe being property managers.
Okay, that makes sense.
When a bank forecloses, the property becomes what is known as REO, or real estate owned. For the bank, an REO property is a toxic liability.
Because they have to maintain it now.
Exactly. They have to pay local property taxes, maintain the landscaping, secure the property against vandalism, and carry massive insurance policies. When you factor in the legal fees of the foreclosure itself, the bank is bleeding cash.
So it's a huge drain on their resources.
Yes. So they will often agree to a short sale, taking a measured loss on the principal, simply to avoid the carrying costs of owning a vacant house in Sarasota.
I see. So they are choosing a calculated, immediate haircut over a prolonged bleeding wound.
Precisely. And for the homeowner, the motivation comes down to the nuances of long-term credit survival.
Yeah.
A short sale is deeply damaging, yes. It will drop your score significantly.
But it's not the worst case scenario.
Right. The ultimate goal in the pre-foreclosure phase is avoiding the catastrophic finality of a completed foreclosure. In the financial world, a foreclosure is essentially a 7-year financial quarantine.
A 7-year quarantine, meaning you are completely isolated from the traditional borrowing system.
You are locked out. A finalized foreclosure remains on your public record for 7 years. Securing a new mortgage, financing a vehicle, or even passing a background check to rent a basic apartment becomes incredibly difficult.
Wow, even renting an apartment.
Yep. Lenders view a short sale as a borrower who experienced a crisis but actively worked with the bank to mitigate the loss. A foreclosure, on the other hand, is viewed as a total irresponsible default.
Which brings us to the third option on the table, which is just letting that foreclosure happen.
Doing nothing.
Right, the timeline is 6 to 12 months of just waiting for the judicial hammer to fall. It requires zero. You literally ignore the mail and do nothing. But as you just outlined, you are handed that 7-year financial quarantine.
It is the path of least resistance, resulting in the maximum possible penalty.
Which forces us to look at the stark outlier in the guide's data table. The fourth option, the direct cash sale.
The fastest route out.
Exactly. This is presented as the optimal circuit breaker. The timeline is incredibly compressed, taking just 7 to 14 days. The effort required is extremely low, bypassing staging or repairs. And most importantly, if the sale is completed and the mortgage is paid off before the final default judgment is entered, the long-term impact on the borrower's credit is minimal.
It is a radical departure from the traditional banking machinery. The cash sale leverages sheer speed to completely eliminate the problem before the bank's gavel can fall.
The numbers make a really compelling case on a spreadsheet. But spreadsheets lack empathy.
They do. They don't tell the whole story.
They don't explain why a family finds themselves trapped in a judicial timeline in the first place. Missed mortgage payments rarely happen in a vacuum. Let's shift from the financial architecture to the human element outlined in the text.
The guide is actually very explicit about this transition. Financial distress of this magnitude is almost universally precipitated by a sudden, catastrophic life event.
Right, people don't usually default on purpose.
No, homeowners do not simply wake up one Tuesday and decide they are bored of paying their mortgage. The text highlights unexpected medical emergencies that drain savings accounts or a sudden corporate downsizing that instantly wipes out a household's primary income stream.
Yeah, the guide places a particularly heavy emphasis on divorce properties, too.
Yes, that's a major trigger.
Let's look at the granular math of that scenario. When a couple separates, the structural integrity of the household budget just collapses overnight.
It is a brutal mathematical reality governed by debt-to-income ratios, or DTI. When a bank initially underwrites a mortgage for a married couple, they're usually calculating the affordability based on 2 distinct income streams.
Right, 2 salaries paying for 1 house.
Let's say their combined DTI is a very healthy 30%. When that household fractures and one partner moves out, the remaining spouse is suddenly attempting to service a dual-income mortgage on a single salary.
Which is almost impossible for most people.
The DTI balloons from 30% to perhaps 70%. Mathematically, the budget breaks instantly. No amount of budgeting or, skipping lattes can bridge a structural deficit of that size.
But beyond the math, there is a massive psychological barrier. I mean, if a home is compromised by a job loss or a divorce, the hardest part for the homeowner isn't necessarily dialing the phone to call a real estate agent.
No, it's much deeper than that.
Right. The true friction is the emotional hurdle of recognizing that a beloved family asset, the place where you hosted Thanksgivings, where you painted the nursery, has fundamentally mutated into a toxic liability.
It's like a sinking ship.
Exactly. It's pulling you under. It takes a profound psychological toll to accept that the walls around you are actively destroying your financial future.
That emotional paralysis is deeply human and completely understandable. Yet the guide anchors its entire philosophy on a very cold truth. Acting decisively when life circumstances change is the single most effective way to preserve your accumulated wealth.
You have to push past the emotion.
You do. Emotional paralysis is the most dangerous reaction a homeowner can have during that judicial timeout.
Because Ignoring the certified letters doesn't stop the bank's legal department from drafting the lawsuit.
The bank's machinery is entirely devoid of emotion. By avoiding the mailbox and hoping for a miracle, the homeowner is systematically stripping away their own options week by week.
Until there's nothing left.
Exactly, until the only option left on the table is the 7-year quarantine. Liquidating a divorce property quickly, for instance, prevents the asset from falling into foreclosure while the couple is distracted by complex legal separation proceedings. It stops the financial bleeding immediately.
Okay, let's focus on the mechanics of that liquidation. Because if time is the absolute enemy and emotional paralysis is the primary internal risk, how does this direct cash buyer mechanism actually execute fast enough to beat the court's deadline?
It's all about bypassing the usual roadblocks.
The guide positions this as the ultimate escape hatch, but how is a 7-day timeline even possible in real estate? I mean, standard closings take 30 days minimum.
To grasp the speed of the cash model, we first have to dissect why traditional retail real estate is so notoriously slow. If you list a distressed property the conventional way, you immediately hit friction.
Right, staging, pictures.
Yeah, you have to spend out-of-pocket money on cosmetic repairs just to make the house presentable. You endure weeks of constant showings. And when you finally secure an offer from a retail buyer, you are entirely at the mercy of their lender's rigid underwriting process.
Which involves a gauntlet of professional appraisals, nitpicky property inspections, and the buyer's own loan contingency periods.
Exactly. An FHA appraiser might flag, peeling paint on a windowsill and demand the homeowner fix it before the bank will fund the buyer's loan. This conventional underwriting pipeline takes 45 to 60 days at a bare minimum.
Which you don't have if the clock is ticking.
Right. And here's the truly chilling detail regarding pre-foreclosure. A lender will not pause a scheduled public auction simply because you have a retail buyer under contract.
Wait, really? This is a point that shocks a lot of people. You can have a signed, legally binding contract with a family who wants to buy your house.
Yes.
You can show the bank that the buyer is just waiting on final underwriting approval. And the bank's foreclosure department will still proceed with auctioning your house on the courthouse steps.
They absolutely will.
That is insane.
It is, but the bank's legal department and the loss mitigation department, they often operate in completely separate silos. The foreclosure machinery does not care about your retail buyer's mortgage delays.
So it's just a race against the calendar.
If the court-ordered auction date arrives before your retail buyer officially closes and wires the funds, the bank takes the house, period. Listing a distressed property on the open market while the judicial clock is ticking carries an immense, often completely unrecognized logistical risk.
The traditional pipeline is fundamentally too slow.
Way too slow.
Which illuminates the true utility of the cash buyer model. Firms like the Sarasota family-run buyers operate outside the traditional banking infrastructure entirely. Because they are deploying liquid capital, they bypass the underwriting gauntlet.
There's no middleman approving the loan.
Right. There are no loan contingencies to fall through at the 11th hour. There are no bank appraisals demanding the roof be patched before closing. They buy the property as is in a matter of days.
And because the homeowner retains the legal title right up until the gavel falls at the public auction, they can execute this cash sale at the absolute final hour.
Literally days before the auction.
Yep. They can take the investor's cash, pay off the mortgage land in full, and terminate the bank's lawsuit just days before the repossession is finalized. They basically outrun the legal machinery.
So what does this all mean? I actually want to push back on one specific logistical detail highlighted in the guide's FAQ section regarding the as-is nature of these transactions.
Oh, the clean-out part.
Yeah. A hypothetical homeowner asks if they need to clean out the property before selling. And the company responds that the seller can simply pack a suitcase with the personal belongings they wish to keep, walk out the front door, and leave all their unwanted furniture, accumulated junk, and debris right there in the living room.
It sounds too good to be true.
It really does. Is that level of friction-free exit actually real, or is it just marketing spin?
This raises an important question about how these transactions actually work, because in the context of a traditional retail sale, it sounds absurd.
Right. A conventional home buyer expects a pristine, broom-swept property upon final walkthrough.
They'll refuse to close if there's trash in the garage. But in the specialized ecosystem of distressed real estate investing, absorbing that physical burden is a core component of the business model. You have to look at the arbitrage of friction.
And the arbitrage of friction, meaning the buyer is trading convenience for a guaranteed closing.
Exactly. These investment firms know they are dealing with individuals who are profoundly overwhelmed. The seller might be navigating a bitter divorce, recovering from a major surgery, and simultaneously staring down a terrifying bank lawsuit.
They don't have the energy for a garage sale.
No, they don't. If the investor demands that this exhausted homeowner rent a commercial dumpster, hire a crew, and spend 2 weeks hauling trash out of the garage, the entire deal might collapse simply because the seller lacks the physical or emotional bandwidth to complete the task.
The homeowner would just throw their hands up and let the foreclosure happen out of sheer fatigue.
By coordinating all cleanup procedures and debris removal post-closing, the cash buyer actively removes the final barrier to execution. The investor secures the asset without delay, and the homeowner achieves an immediate clean break from a suffocating mortgage burden.
It's just baked into their operating costs.
It is a calculated operational cost that guarantees the transaction beats the judicial clock. It is a stress-free exit strategy.
It is a fascinating subsector of the financial ecosystem.
Huh.
So for you listening to this deep dive, why is this specific knowledge so critical? Even if you live completely debt-free on a different coast and have an immaculate credit score, understanding these underlying mechanics is essential financial armor.
It absolutely is.
We've explored the true motivations of major lenders, the hidden leverage found within judicial timelines, and the profound difference between suffering a 7-year financial quarantine and strategically deploying a fast cash sale to protect your future borrowing power.
Because true financial literacy isn't just about knowing how to invest, it's about knowing the precise architecture of the systems that can dismantle your wealth.
You have to know how the machine works.
Right. Knowledge is the only effective countermeasure to the panic that sets in when a certified notice arrives in the mail. The power in any financial crisis always resides with the party who understands their available escape routes before the system makes the decision for them.
Which leaves us with a final, slightly provocative thought to mull over. The guide mentions that while utilizing a cash sale to avoid a full foreclosure saves you from that catastrophic 7-year quarantine, your previous missed payments, those initial 90 days of default, will still remain on your credit history.
Right. There is no magical mechanism to erase the past.
Exactly. And this introduces a really fascinating dilemma regarding how we value assets in the modern era. In an age where our financial records are digitized, permanent, and instantly accessible to any institution, how much is the sheer speed of liquidating an asset actually worth?
That's a great question.
If you are facing an unforgiving legal deadline, is the traditional advice of always pursuing top retail market value for your home actually a dangerous, outdated trap?
It very well might be.
Perhaps. In our hyper-fast, highly leveraged economy, the mere ability to sell an asset instantly without friction is fundamentally more valuable than the physical asset itself.
It forces a profound reevaluation of what equity actually represents. Sometimes the highest premium a property can offer isn't its market value, but its capacity to provide a rapid, clean exit.
A completely different way to look at the equity in your home. Keep that in mind the next time you walk out to check your mail. Until next time, keep digging deeper.